Welcome back to this channel. Have you ever wondered why companies can't just switch accounting methods whenever they want? What if a business suddenly changed how it calculates profits? Will you still trust its financial reports? Today, we are breaking down the consistency principle in accounting, a rule that keeps financial statements reliable and even comparable over time. So stick around to learn why this principle matters and how it impacts businesses. That is even your own investment. So let's dive in.
Great. Consistency principle ensures that financial records are prepared using the same accounting methods for similar events and transactions over time. It allows for meaningful comparisons between different accounting periods and between the financial statements of different companies that use the same accounting policies. A perfect example here is the banking sector or the banking industry, where commercial banks have a similar templates they use to prepare their financial reports. And therefore, consistency principle is applicable and can clearly be identified in this industry. Consistency does not prohibit changes in accounting policies. They are permitted, but must be justified and disclosed in the financial statements. Now we can look at some of the key aspects of consistency principle. One of them is uniform application of accounting methods. Here, companies must consistently and constantly apply the same accounting standard from one period to another. That's what is required at this point. When you adopt one principle or one method, then you must apply it from 1 year to another, 1 year to another for ease of comparison. There's also disclosure of changes. If a company changes an accounting method, then that company must be or is required to explain the reason for the change and the impact it will cause to the company, or quantify the impact on financial statements, e.g., in the footnotes, these disclosures must be noted there, the reasons as to why the company decided to board or to onboard a different accounting method as opposed to use the one they have consistently used. There is also a key aspect in enhancement of comparability and reliability. This specifically touches different stakeholders, especially the investors, the creditors, and the regulators, because they rely on consistent financial data to analyze different trends in businesses, different trends in market, or different trends in sectors, different sectors of the economy. So therefore, this method is very important for that purpose of comparing and also to see whether they'll be able to rely on the information presented to them. Another example here we can look at is where a company uses the straight line method of depreciation, but it has determined that the declining balance method is more appropriate, and therefore they move to use the declining balance method. So the following year, the management then determines that that change from the straight line method to declining balance method is likely to negatively impact the net income, and therefore they want to make a change back to the straight line method. Consequently, another change will violate will violate the consistency principle, and as there is no justifiable reason to do so. Because consistency prohibits companies or organizations from changing from one method in one financial year to another financial year. That will cause a lot of confusion to the users and stakeholders of financial statements. So professional accountants advise that, or the regulators advise that once you adopt one method of accounting, use that method consistently from one period to another, unless there is a justifiable reason as to why that change is necessary. Additionally, consistency principle has a number of exceptions, and one of them is the release of new accounting standard. This is whereby bodies like the Generally Accepted Accounting Principle Body or the International Financial Reporting Standard body may come up with a new standard that maybe a company, or that standard will be useful if a company adopts it. And this is an exceptional chance where now a company can adopt this new standard for purposes of their internal policies and operations. Another exception is where there is change, or the change from one method to another will provide more accurate reporting, and therefore this method can be adopted. We can also look at the importance of consistency principle in finishing. One importance here is the investor confidence. Consistency principle ensures that financial statements are reliable. And when they are reliable, then they are likely, or they definitely serve the investor's interest. Another importance is the regulatory compliance. When consistently used, the consistency principle will definitely meet the requirements of the regulators of the financial operations or the financial reporting. And that is the GAAP, the Generally Accepted Accounting Principles, and the International Financial Reporting Standard. This is a requirement by these bodies to ensure that financial records or financial statements are prepared consistently and as per the regulated or the available standards that guide the preparation of financial statements. Another importance is when you use the consistency principle, then to some extent prevents the earnings manipulation. It stops companies from what we call shopping for favorable methods. Because when you use a management may adopt a method that they deem fit for their own interests. But consistency method, once applied, every stakeholder will know that it's here for purposes of ensuring the company runs smoothly and does not alternate from one method in a financial year to another method in another financial year. So that is covered. So it prevents earnings manipulation, and therefore all reported earnings where consistency method is applied they are proved and they can be relied upon by the users. So in finishing, consistency principle will automatically promote comparability and transparency in financial reporting. So while companies may change, or companies can change methods from one year to another or from one period to another, but these changes must be justified and they must be disclosed to maintain trust with stakeholders. Because when you change a policy or when you change a method without informing the stakeholders, then the stakeholders will not be able to rely on the information you provided for them. And therefore, consistency plays a vital role when it comes to financial reporting. And if at all there is need to change, then this change has to be communicated to the right stakeholders of the company, to the right stakeholders of the business, including the users and the regulators of the such standards.
That marks the end of consistency principle. If you found this video helpful, please don't forget to like, to share, and subscribe. If you have any comment, any question, or any topic you may want us to cover next, please drop it on the comment section and I will respond to it. See you in the next video.